I'm thinking back to the last time the Fed started tightening, right? And so, first of all, when the Fed minutes just came out, two things that were really, really interesting. So first of all, it's that potential 50 basis point increase in May, which is significantly more than what we were thinking with the 25-point increase. And then also they talked about how they were going to reduce their balance sheet. And so really allowing their existing bonds to mature. And so the last time this happened, they did this was around between 2017 and 2019. But a couple things were different. First of all, the pace was 50 billion, not the 95 billion in reduction that they're talking about. And the reduction didn't start until a year after the first rate hike. But how stocks performed in the short term, to your question, they did actually well in the first year of the balance sheet reduction. So stocks took a dive about 20%, but that wasn't until after the tightening.
Yeah. Well, we're looking at a longer-term chart of yields. I mean, Tiffany, the bond market really has maybe done the work of the Fed, has it not? Because while the Fed is kind of saying, well, we're going to do this and we're going to do that, the bond market at 2.75 on the 10-year, up, what, double from a year ago or whatever it is? The bond market has become the Fed, it feels like.
The bond market has been working overtime lately. And so as an investor, I'm thinking, well, if that is going on, will the Fed change course? Do we really need the 50 basis point increase? So, listen, time is going to tell. And we do have more meetings of the Fed throughout the rest of the year. So, my hope is that the Fed will proceed cautiously, as they've been doing for the past 2.5 years, as we've been talking about tapering and tightening, all of these things. They've really made it clear that they're going to really watch and see the data. So I hope that they do that in the case here, because you're absolutely right. The bond market really has been doing the job of the Fed lately.
Yeah, it certainly has. Futures, NASDAQ futures, by the way, are down. I guess the idea being that, big tech in particular, Tiffany, does look more vulnerable to rate shocks or balance sheet shocks or whatever you want to call them. It's not been the kind of April that many had hoped for. It's early.
It hasn't. I mean, quite honestly, it hasn't been the kind of year that many have hoped for, right? I mean, look at the drastic difference even in volatility between this year and last year, right? But again, and especially in tech, we can look back to 2020, we can look back to 2021 and see how well tech was performing. And now in 2022, it's a drastically different situation. And I know many people are thinking and wondering, well, is this a good time to buy tech? I'm always in the tech camp. But for me, it's not really about painting industries or types of companies with a broad brush. It really is, and I've said this on your show before, for me, it really is the year of balance sheets and business models. And so I'm really looking for those diamonds in the rough for those companies, no matter what industry they're in, who are really able to weather these major headwinds, right? So, of course, supply chain issues, rising costs, all of these things. Are they able to pivot and navigate? And especially in this time of major headwinds, are they able to increase their margins? So I'll be watching for that this earnings season.